Okay, perfect. So I think first things first about the exam. I just now wrote a LinkedIn article there. I'll give you sort of a brief summary. Um, I okay. Yeah. So what we checked with a couple of people in our network, the folks that we know, etc. and all, in terms of what this exam entails, right? For the distributors per se, right? I think couple of things. To be frank, so think of it like this. What they're saying at this point of time. See, NISM hasn't released anything officially. I think some of the questions are getting unanswered. I mean, like they're not, responding to the emails, and we're still awaiting if they wanted to do a webinar. Okay, but at least from the people that I spoke with, who actually spoke with NISM directly. So here is what the situation is at this point of time for this exam. Okay, if there are two types, right? If there is an existing, if there is a new entrant who want to come and who want to distribute mutual funds, only mutual funds, the NISM, the 5A exam, which we all have written, still holds intact. Okay, that 100 marks, no negative marking. I know that still holds intact. Okay, at this point of time, I think NISM is not removing it or whatever. If there is a new entrant who wants to, do both MFD and SIF exam, together, they are like, hey, let me crack both of this together. They have to attempt the series 5D. Okay. For the new entrants, so there are just two options. I can choose only MFD, or I can actually become an MFD plus SIF distributor, at one go by going to the 5D exam. But in case if I am an existing distributor, which we are all, where you all fall under, I think the you can consider 5D exam as a SIF exam going forward from July 22nd. Okay. Um, the NISM 13 still remains the same, but that is not the exam that you have to clear to get your SIF distributor license. What they're saying, I think we're still awaiting on the clarity there. I think that answer we still couldn't get, from the folks, especially from NISM. But if you want to, attempt SIF exam post July 22nd, or when this exam is available, um, now, for this, like, we will try to get, an answer tomorrow in terms of like what happens to that. 13 still stays put is what we have been told. But like, if that is considered as a SIP distributor exam, or this SIP distributor exam, we were told that 5D is generally considered as a SIP distributor exam. Okay. So that is actually what is the change for you all um, going forward. Um, so I think on the changes we have already discussed that multiple times yesterday. Um, this exam primarily the heavy weightage for 45%. And unfortunately, if you are picking up this exam, if you are already in MFD, and if you are picking up this exam, unfortunately, you have to read through that, the entire stuff. I think it should be easy because, as I said, it's a day in and day out of what we do as part of our jobs, whether it is NFOs, talking to people, new tech platforms and all that stuff. Uh, so uh, currency derivatives is completely gone. So even as part of this program, we will not touch currency derivatives. There is no point of learning that. Uh, Within equity derivatives and interest rate derivatives, we mentioned about chapter 6 to 10, 6 to 10, both are gone. So there is no point of even reading those. Uh, Equity derivatives and interest rate derivatives, only chapter 1 to 5 and 1 to 5 only remain. Okay. And out of that, we have already covered chapter 3 in equity, chapter 3 in interest rate. We have covered chapter 4 in equity, and we have covered chapter 4 in interest rate. Okay. So we covered most of the chapters, right? And yesterday we started with the chapter 5, strategies using equity derivatives. We will continue to build on that, going into the next week, because we have to study bullish, bearish call spread, butterfly spread and all that stuff. Those are little tricky concepts. we will also try to learn these concepts. I will teach you from the exam perspective what sort of questions will be asked, but we will also try to learn these concepts because uh, as a SIF distributor, you need to learn those concepts. It might be to talk to your investors going forward, once you clear this exam, right? So once you put it into your brain, I don't think it should be easy for you. Okay. And then, the chapter 5 of the interest rate derivatives. Chapter 1 and 2 are easy. To be frank, we need not even study. I mean, study in the sense, we need not go through the class, but I'll quickly glance through. Just hardly takes 10-15 minutes, nothing more than that. Okay. So we sort of covered for this from the new exam perspective, we have actually covered most of the syllabus. We will try to cover this chapter and the interest rate derivatives chapter, next week. So instead of 21 days, I think we should be able to get it done in whatever, 14 days or whatever. But the tricky part here is if you have already applied for, currency derivatives exam and ISM 13, uh, we are still unfortunately not in a situation to recommend anything. Okay. The reason being, if you're very confident that if you put in a lot of effort and if you've already confident of clearing that exam, just go ahead and give the exam. And even if you're not confident, you can also go ahead and give the exam, right? um, and in case if you don't clear, that's still fine, because this exam is I think should be super easy. The whole mutual fund is all concepts only, nothing else. I've gone through the syllabus entirely, and what we will try to do might be over the weekend or early next week. There are all the whole page. I think Anup sir already shared that. There is 600-page PDF document. So what we will try to do is, we'll try to glance, and if we can, summarize each and every chapter and get your notes, we will try to attempt that from the MFD perspective, right? Equity and interest rate, we already have the notes and we already have the questions. We need not worry about it. Okay, cool. Take a quick break, here. Sorry, quick pause. Any questions on that exam part, or can jump to the class?
Yeah, Kiran, just one
Yes,
request that MFD part के लिए कुछ मटेरियल है क्या, रिवाइज करना पड़ेगा ना एग्जाम पर्पज से? पता होना और एग्जाम में बैठना दो अलग चीज है.
That is true. Yeah. So that's what we are saying. Give us time until early next week or next week, mid of next week. We will try to get you all the material, from the book. I think you already shared the PDF on the group. So we will convert that and we will get you the material and notes for you. I think it should be super easy, sir. I don't think there is lot of trickiness, but we will try to get the questions if possible, and we'll try to get all the notes there. Yes.
That will be great. And what do you think would be the numerical part? Will it be little lesser now?
See, the tricky part in NISM 13 always has been, as I mentioned before, the use cases of the currency derivatives, right? We started with that exporter importer, and we mentioned that, we will discuss and build on that. Fortunately, I think we need not study that. So those have been most of the tricky case studies. Okay. I think, see, 6 to 10 and 6 to 10 chapters doesn't have any numericals there. It's all only theory. So that whole theory has been removed. So I think from the numerical perspective, we have already studied it, right? Whatever we have done in the introduction to futures, introduction to options, we have already studied, decent amount of numericals there. What we will do is, we will keep the content and the questions. See, when we built this program, we have questions. We have segregated the questions based on the chapter. So we have, I think, close to 60-70 questions, for these chapters, for chapter 3, 4, 5. So 180 plus 180, close to 360 questions are there. We will just practice that. That actually is more than sufficient for you to, clear that exam. From the MFD perspective, we have to see, we still don't know what is going on there. But I think we all have given the, I mean, like MFD exam, MFD, I don't think there are much numericals that they can ask. Primer. So, nutshell, I think whatever we have covered should cover your numericals. There are no additional stuff. The case studies of currency derivatives is completely gone now. Any questions,
Great.
guys?
Thanks.
I hope you got some clarity compared to yesterday. The one clarity is on like, the 13 exam, for the ones who are already attempting to do. Let me try to get an answer by tomorrow, because we tried speaking with so many people, but it's so much of haziness. Unfortunately, I don't know why they do that, but it is what it is. Yeah. Okay. Anything else, guys? If not, we'll switch to the class today quickly. There is a comment. 1 second. What is the comment? Message. Numerical part. Okay. Yes. Okay, we answered that. Okay. Perfect. Let's switch to the class. So have a hard stop at 7:45. So what we will try to do is we will try to study two things today. One is this one, and we have already covered this part. We will do arbitrage, and before that, before that, what we will do is we will do how do we hedge a portfolio using index futures. Okay, we'll go through our example like the word thing, and then we'll come to the PPT on how we do that, right? Just give me a second. Okay, primarily, so there is always we have studied recently, and I think we keep reading that in the MFD thing also. Market always have two types of risks, right? Systematic risk and unsystematic risk. Unsystematic is the one which we are able to control, and okay. Unsystematic is where we will be able to control through diversification, etc. and all. Systematic is unfortunately not in our hands, right? It's unfortunately you know yeah, at this point of time, I think it's a vagaries of the Trump statements, right? Whatever he speaks, there is a systematic risk that creeps into the market each and every day. So let's take a particular scenario. What did we talk about? Futures and options. Primarily, they're used for trading. They're used for speculation, and also primarily the most important part is they're actually used to hedge the risk, right? So imagine now I have 15 stocks. Okay, I have a very good basket of 15 stocks that I have created. Imagine now I have created this basket across 5 different sectors. Okay, so primarily what I have done, I have actually already diversified my stock picking. 15 stocks and 5 sectors, and I have already decently diversified. Okay, and I'm super confident, right? That like the market will go up only. Okay, the market will go up. Okay, but having said that, can I be like super confident in markets? Absolutely not, right? The markets, what we say is the so-called market mata is extremely supreme, right? Than anyone else. Anything can happen in the markets. If someone can predict what is going to happen tomorrow, how the entire day, how the Nifty will run, Bank Nifty will run, like, I don't think anyone could do that, right? If someone is saying that, they're actually sort of bluffing. So always what has to happen in the market is always you need to protect the, risk, by hedging it. Okay. So in this case, even though I'm actually decently diversified, in terms of like, the 15 stocks across different 5 sectors, but I always have the creeping of the systematic risk count, right? For example, like, what exactly has happened in the month of March, right? Or for example, what actually has happened in the month of September, October of 2024 for us, right? So markets have taken a certain level, and then they actually started, falling and falling and falling, right? So March, the completely the war situation and like, the sorry, war situation and like, Nifty 500, corrected almost 11.5% on that particular month, in the month of March. So there is always a potential of systematic risk. Here, what did I do in the first place? Here, I have removed my unsystematic risk by diversification, right? I have sort of picked up various stocks and various sectors, and I have sort of diversified. I sort of try to eliminate my unsystematic risk to a greater extent. But the systematic risk completely still exists, which is what I just now mentioned about the war thing in the month of March and 24 in September, October, like, the overheating of the market and when the market actually started correcting and all that. Now, how do I, now in this particular case, what are the two potential scenarios for me? One potential scenario is if I feel that, the market is going to fall say next month, okay, sometimes what people do, is most of the guys that you hear on this, TVs and all, oh, sell it off, sit on cash, sell it off, sit on cash, sell it off, sit on cash, right? So that's what most people, say, right? There is one potential scenario for you to actually sell off all your 15 stocks, which are your highly picked stocks, where you have diversified, where you have created a nice basket of the portfolio. You can actually sell off everything and sit on cash, anticipating that the market will fall. And like, when the market recovers, might be I will create a new basket, a new portfolio there. But that's not the case generally. What can happen, right? As I said, no one can anticipate. Now, how do I protect that? The way how you protect that, primarily hedge, especially for the stocks. This is a very common thing, and this is one of the strategy most of the SIF guys also use. And this is a very common thing is we actually take a short position against the index futures. Got it? I'll explain that in a bit. What am I going to do? Like, I have a very good portfolio here, that I have built. I'm thinking it is supposed to go up, it will go up. But there is an, systematic risk that I have to protect against, the hedge that I have to do. So what I will actually do is I will actually take a short position in the index futures against this basket. Okay. How to do that? The calculation will just see in a bit. Let me take a quick pause. Everyone clear on this? First things first. Cool.
But hedging is must, right?
Hedging is not a mandatory thing, to be frank, sir, right? But hedging is where it makes a investor or a trader a highly successful one to the one who actually loses one. It always protects your risk, right? Why do we take insurance, right? Why do we take auto insurance is what? Insurance is a hedge against the risk, right? That something is going to happen to the car or someone actually will hit our car without even our. See, what is systematic risk in terms of the car, which actually happened to me twice, recently. I was waiting at the signal and like all of a sudden, like, someone from the side comes and hits me. Do I anticipate that? No, right? That's a systematic risk for me, right? How do I protect against that? By actually taking the insurance. That's what I'm doing. It's actually the hedge. Just please put yourself on it. Yeah, thanks. So that is what it is. So to like, do I not? Do I need not? I mean, do I have to take insurance compulsorily? Of course, with the rules and all, might be I have to take compulsorily, right? But if there are no rules, say if they say the Motor Vehicles Act says, insurance is not mandatory, insurance is optional. Okay. Will I take the insurance or not? That's up to me, right? If I'm taking the insurance, I'm protecting my car. In case if I'm not taking my insurance, God knows, right? And if something happens to the car, I might not be able to protect the car. But how many times will it hit my car? Again, no one knows, right? So it's all about that. You got the points?
Yes, sir. Thank you, sir.
Okay. Okay. Now let's go through, the sort of how do we do that, right? So what is index? Index is Nifty, primarily, or the Bank Nifty or the Sensex, right? I'm not doing please remember this, and I'm not, sorry. Yeah. I'm not actually doing against the stock thing. I'm actually doing against the index. Okay. Now tell me, what is the number one question that can come here for you guys? What is the number one question, that can come here?
How do you place the quantities? Because
Sorry.
how do you place the quantities in the stock?
Very good. Lovely. Lovely. Super awesome. Lovely. Right? I told you index futures, but like at the end of the day, the question is kitna quantity lena chahiye, right? That's $1 million question, right? Kitna quantity lena, okay? So for that, what we will actually do is first, we will actually calculate, the beat. Say for example, if I created the 15 stocks, right? 15 stock portfolio, I will have weightage to each and every stock, right? It's not like, see, either I can have an equal weightage, or might be I can say, okay, hey, some sectors have a heavy weightage, and some sectors don't, the weightage is little lesser, so that is what is called as portfolio construction at the end of the day, right? So what the formula here is, what I will be doing is, the beta here is stock price, the beta of say stock 1 times the beta of that stock. So beta is generally available for you. I think mostly if you go to screener, trend line, if you're stock trader, etc., and all, like the betas are generally available, right? So similarly, what I will do, beta of stock 2 times beta of stock 2 plus it goes on, right? That will actually give me the beta, the entire beta of my stock portfolio. Clear, everyone? I think beta is a very interesting concept which we will also study in the sense, like, in the mutual fund also, but like this is what it is, right? The beta of that stock times beta of that stock, gives me the entire beta of that entire portfolio. Okay. And then what I will actually do is, so let me take a example here of, say for example, my portfolio here is something like 90 lakhs. You might say, Kiran always talks in higher numbers, but just for hypothetical example. So 90 lakhs, right? Then what is the formula, and also the most important part, right? So for example, the Nifty price is something like 23,500. I'm just taking just a hypothetical example, right? And what is the Nifty lot size for us? Nifty lot size is 65, right? Okay. So the formula goes like this, right? And imagine now the beta of this entire thing, has come to me as something like 1.3. Okay. Again, hypothetical, So the formula is 1.3 times 90 lakhs for me divided by my the future price times my lot size. Okay, so this is Nifty, not spot price. This is future price by time. Okay, so this is going to be my lot size. Okay, then let's just quickly calculate. Anyone wants to calculate and tell me? कितना है सर? Anyone? No one is doing calculation. Array, come on. Okay, let's do this. 23,500. 23,500 times 65. Okay. So what is my thing? 11.
7.659 per है.
Okay, got it. Thanks. Thank you so much, sir. Okay. कितना हुआ sir? 7.6, sir?
7.6595.
Okay. 7.69659, whatever, right? So something what I have to do is, closer to how many lots, how many, features I have to take primarily. I have to take a quantity of like, 8, 7.5, you can't do that. Like, primarily it's in increments of 1. So ideally, I have to take 8 lot futures there, actually. You're getting my point, right? So to cover my 90 lakh portfolio, from the systematic risk, I'm actually hedging it against the index futures. And the number of index futures that I have to take is actually close to 8. Got it? Everyone clear, on this? Any questions? Any questions, sir? Everyone? Anyone? Good, bad, cool, good. Okay, clear. Perfect. Okay. Now let's actually come to, the different set of one more hedging. See, by the way, you need not worry about, this much of math, etc. and all. And we are learning this because it's also useful for you even in your personal thing if you want to trade, etc. and all. But like from the exam perspective, yeah, I mean, like you don't get, the sort of the mathematical questions, this sort of stuff. Anyways, but you would never know, this new exam. Okay, but it's always good to learn, primarily. Okay, now the next concept. So this is the concept, that I have, shown you, right? Well-diversified portfolio, has near zero specific risk, but it is always exposed to the systematic risk, market risk. To hedge against the potential market crash, what we do is we take a short position in the index futures rather than selling the entire portfolio. The market falls, losses on the portfolio are offset by the gains on the short index futures. Okay. Number of lots to shed is, decided by the hedge ratio. What we have seen, I've actually shown you the calculation here. Okay. Okay. Quickly. Now, just moving on, I think we have already done this yesterday, in terms of like, if you're a bullish thing, you take long futures, etc. and all. So this is not actually hedging, by the way. That's why I actually use the word speculation on top of it, right? So what can happen, in a potential scenarios, for example, if I am a trader or an investor, and if I feel like, super bullish, right? See what happens with Indian markets is, I think Indian markets are little predictable markets, because the sectors keep rotating and there are a couple of sectors which actually has momentum at a certain point of time. For example, what we have seen in PSCs in 2023, of course, there is a logic to it, why it went high. And then like, at one point of time, defense went high, right? Like all the NFOs are defense related NFOs. Similarly, at one point of time, automobiles went high, and all that, right? So what actually happens is, say, for example, if I feel that, that particular sector or the stock will continue to do really well, I can actually, again, this is not hedging. This is actually speculation. Okay. What is speculation? I'm taking more risk, who are speculators. Speculators are risk traders. That's what we have learned, right? We've learned, characteristics, hedgers, speculators, and arbitrages. Okay. We've seen hedge. We'll do speculation, and we'll do one quick example of arbitrage if we have some time today, or we'll continue in the next class. So in the case of speculation, what I will do is I will take both the cash call and as well as I will take the futures call. Because because I feel I am very confident on that particular stock to go up, and you could call like me a little greedy or whatever, but like because I'm a risk trader, I'm actually taking both cash position and as well as the futures position. There's not much of a math here, it's pure speculation. So primarily, the prime takeaway here is why am I taking futures? In the case of futures, I am making close to 18% return. In the case of the actual stock cash, I'm making a return of 3.62. And also what happens is, we have discussed this multiple times and we have seen that yesterday also. the cash positions are always expensive positions, right? You need more capital to take these positions. Got it? Clear, guys? It's very straightforward, simple, nothing else. Any questions on this? Any question?
Show that example of hey,
Sorry?
you calculate the margins and what is the cost as well. So
This
that's
one?
also, so you speak about the heads then.
Sir, your voice
Previous
is cracking. I couldn't hear properly. You need to come little closer to the mic.
So you've spoken about the hedging strategy of that in the overall portfolio. Do you also consider the cost as well? Because there comes with a cost as well. If you're taking the future position of the Nifty, so you need to pay some margins as well, right? So it's going to be calculated there, and then you're going to do that, or how is it going to be done?
In this example or in the previous example?
Previous example. So overall portfolio, you're taking the hedge.
So there I'm not actually taking the options, no, sir. I'm directly taking the futures. See what happens in the futures. So see, in the case of the futures, what was my calculation here? My calculation was here. Let me go back to my calculation here. Right, that's a good question. I'm directly taking the position here, right? See here there is no point of margin. What was my calculation here? What is my price involved here? 23,500 times 65 is my price. So there is no concept of like the margin that is coming here. I'm taking the entire position there. See something like what happens in Reliance, sir. 1305 and all, right? By calculating with that. Okay, guys. Any questions on this? Short, not where are we? Speculation, right? Okay, bearish view. Same concept, in case of the bearish view, what I will try to do, I will actually sell the call, sell my, see, you can't actually sell the stocks in the market, primarily, you have to take only either futures or options, but like, if it is a bearish position, I will actually short the futures, in the case of the speculation. Got it? Indian market does not allow you actually to, sell it and hold it, for the delivery positions. Okay. Questions? Any questions on this? You understood this? If I feel that market, the particular stock is going to fall, what will I do? I'll actually sell the futures and I'll just sit on it for me to make money there. That's it. As simple as that. So 1602 is my price. I'm expecting the price to fall to 1527. The lot size is 550. Right? I take sell future position at 1602 and I'll exit at 1527. So what is the price that I'm making? This minus this times 550, 41,000. Okay. Clear, guys? Questions? Okay.
Yes.
Let's see this quickly. I think let's try to. I said I have a hard stop at 7:45, but we'll try to do possible if we can do it in the next 10 minutes. So the first things first, and I want you to understand this part here, right? What is arbitrage? Anyone want to give a cut?
So taking the price differences of the different markets and playing there.
Perfect, right? So primarily, right, see, markets are not, markets always have, how should I say, we can't call it as even irregularities or whatever, but market actually misprices itself sometimes, right? There is always mispricing that happens between, different, price between spot. Yeah, you can call it anything, sir, actually. So see, there is always a price differential. There is a mispricing that happens between two different instruments in the market. Okay, it can happen in the, so let me put it this way, right? We'll take a couple of quick examples. For example, if you see, whenever, I don't know how many of you actively trade, right? So if you see Reliance price on NSE, vis-a-vis Reliance price on BSE, those are always different, prices. Okay. The price difference between BSE and NSE, that price differential is called actually arbitrage. Got it? Primarily, of course, they don't allow you to buy it at one exchange and sell it at one exchange, but This generally happens in crypto when I was in the crypto world, but what people do is they buy it in one exchange at a lower price. The same stock, they will sell it at a higher price in other exchange. Okay. The difference between, what do they make? They actually make 0.1, 0.2, 0.3 points as a difference. That's it. But they will play on huge quantities. Primarily high frequency traders, and hedge funds actually do, heavy arbitrage opportunities. Okay. Because they actually come sometimes, like that's what I was telling you. Might be you should check that. Go to YouTube and do industry, and there is one nice video. If I find it by night tonight, I will send it to you. What happens is so there is a prediction that the interest rates might go up, right? They what what you will do is you will actually buy in one exchange, and you will actually sorry, that's not a example at all. Primarily you make the money within shorter point of time, and that money will be in couple of millions of dollars or whatever it is. Okay, anyway, that is what is called arbitrage. So let's come to this particular example and let's quickly go through this. So for example, there is a stock setup. The cash market price is 1500, and the potential 3-month futures price at this point of time is 1550. Okay, it is available for us directly, right? Okay. Now we discussed about cost of carry, right? For futures, always there is a cost of carry. We studied in the gold, right? What is it like? I'm actually not taking the possession of the gold. So the gold shop owner has to take care of the insurance. He has to keep it in a vault, which means there is a carrying cost of the vault for me. There is an insurance, everything that is involved there, right? So there is a cost of carry, say in this case of the future contract here. Okay. Now the first thing what we will be doing is so I don't know how I can actually show you the exponential thing. So this is generally the calculation here, right? The calculation here is let me put it here. Might be I'll put it here, so that it is easy. Okay. So first of all, I wanted to understand whether my cash market price and my future market price are going hand in hand or not. You're getting my point? My cash market price or my future contract price, are they going hand in hand, or is there any arbitrage opportunity for me to play there? Everyone understood this? Is it like sort of a linear thing, or there is a sort of a mispricing which I can actually play, is what I wanted to find out. Okay. So the way how we will actually do that is primarily, so it is like 1500 is my cash price times, don't worry about this, you won't get these questions, the maths here, this for the understanding purposes here, right? E to the power of, what is the cost of carry there for me? 9% per annum, which is 0.75% per month. Okay. So this is to the power of, right? So remember that 0.0075. Why? 0.75% is my cost of the carry times how many months? 3 months, right? 3 months. This is sort of like, what I'm going to find out initially, right? You can do it at your end if you want to, but primarily this comes to actually at give me one second. Yeah, this actually comes down to 1534. Got it? So ideally, I'm repeating this quickly. Might be we'll do this example again in the next class. So initially, what did we say about the future contract? The future contract value is always equivalent to the cost of carry plus the other costs involved. Okay. So here the 3 months future price is 1550. That is what is getting projected on the exchange for me. But is it the real value of the future contract price for me? I don't know. Okay. So what is the value of the real value of the future contract price? The existing cash price times the cost of the carry firm. Obviously, that is what it is, right? Plus the cost of the carry. So 1500 times exponential to the power 0.0075 because my cost of carry is 9% per annum times how many months? 3 months. So what I will be arriving at, please do the math if you want at your end. The value that I will be arriving at is 1534. Okay. Now tell me what does this mean? Quickly.
Break even.
Come on, sir.
No, right now the price is 1534, but the future price is 1554. There's a difference there. There's arbitrage opportunity.
Lovely. Very good. Right? Whoever said that. So 1550 actual price is supposed to be 1534, sir. Narendra sir, I think so, who has mentioned that, right? It's not break even. Why? It's not even break even, right? The actual price is 1550, but the price is supposed to be 1534 ideally, right? Because that is what my calculation actually shows. So what is the price differential that I have here, for me to play? 16 points. Right? 16 rupees is like, where the arbitrage, that I can actually, primarily play there. So primarily what I will be doing is, I can take the arbitrage position there. Yeah, unfortunately, I have a hard stop now. But we will continue what is going to happen when the price goes up and price goes down in next class. But for this, at least this calculation, this setup, everyone clear on this, on why I have arrived at 1534 and why, how to identify if there is an arbitrage opportunity or not. Everyone clear?
Yes, sir.
Perfect. Awesome. Any other questions? Please on today's session.